Everyone is talking about the AI bubble. Financial media, hedge funds, Reddit, your coworker who just bought Nvidia stock. But here's the problem. Most of the people talking about it can't actually explain what a bubble is, or what specifically makes AI look like one right now. So let's fix that, simply, in 5 minutes. A financial bubble forms when the price of something rises far above its actual value, driven not by fundamentals, but by the belief that someone else will pay even more for it tomorrow. It has happened with tulips in 1637, railroad stocks in the 1840s, housing in 2008. Every bubble follows the same 4 stages. First, a genuine innovation appears, something that really does change things. Second, prices rise and excitement spreads. Third, companies are valued not on what they earn, but on what they might earn someday. And fourth, something triggers a loss of confidence. Prices fall, fast. The tricky part is that the innovation is always real. The internet really did change communication. The question is never whether the technology matters. The question is whether the prices make sense. To understand the AI bubble, you need to understand what happened in 2000. In the late 1990s, the internet was new and genuinely revolutionary. Investors believed every internet company would eventually be worth enormous amounts of money. Companies with no revenue, no profit, and no clear path to either were valued at billions. Pets.com raised $82 million, spent most of it on a Super Bowl ad, and went bankrupt 9 months later. When the bubble burst, the Nasdaq fell 78%. Trillions of dollars vanished. It took 15 years for the index to recover. But here's what people forget. The internet itself didn't fail. Amazon survived, Google survived. The technology was real, but most of the companies built on top of it weren't worth what investors paid. That distinction matters enormously right now. AI is genuinely revolutionary. That part is not in question. But the money flowing into it has started to look very familiar. Since 2022, technology companies have committed over $1.65 trillion to AI infrastructure, data centers, chips, power systems, and software. That is an extraordinary amount of capital being deployed on the assumption that AI will generate returns large enough to justify it. The problem is the math does not yet add up. Microsoft, Google, Amazon, and Meta are spending hundreds of billions on AI infrastructure. Their AI revenue, the money actually coming back in, is a fraction of that. Goldman Sachs published a report asking a simple question: is AI spending too high relative to the revenue it is currently generating? Their answer was yes. Nvidia is currently valued at around $3 trillion. That assumes AI demand for its chips stays at current levels or grows significantly for years. If AI investment slows, Nvidia's revenue slows, and a $3 trillion valuation for a chip company starts to look like the 2000 version of Cisco, which fell 86% when the dot-com bubble burst. The companies building AI are real, the technology works, but the amount of money being spent on the assumption that returns will follow, without proof that they will, is what makes this look like a bubble. Bubbles don't pop because someone realizes prices are high. Prices can stay high for a long time. They pop when the money runs out. Right now, AI spending is being funded by a combination of corporate cash, cheap debt, and investor capital. If interest rates stay elevated, that debt becomes expensive. If AI revenue doesn't scale fast enough to justify the spending, companies start cutting budgets. If one major player announces it is slowing AI investment, confidence breaks. The boring thing that kills the bubble, as the competitor's video correctly identified, is not a crash, not a scandal, not a dramatic event. It is the moment when CFOs at large companies look at their AI spending and their AI revenue and decide the math doesn't work anymore. That decision happens quietly, and then the spending slows, and the chip orders drop, and the data center build-out pauses, and the stocks that were priced for infinite AI growth start repricing for finite AI growth. So, is AI a bubble? The technology is real, the use cases are real. Some of these companies will be worth exactly what investors are paying today, or more. But $1.65 trillion in spending without proportional revenue, valuations built on future assumptions rather than current earnings, and a striking resemblance to 1999, these are not things to ignore. The dot-com bubble didn't mean the internet was fake. It meant prices got ahead of reality. The survivors, Amazon, Google, went on to become the most valuable companies in history. The question isn't whether AI is real, it's whether you're buying it at the right price. If you want more financial stories explained simply, subscribe. Because next, we're breaking down every type of investment, and which ones actually survive a bubble.